Hi, I'm Dan Murphy, Senior Manager in Habif, Arogeti Wynne's Real Estate Industry Group. I'm here today to let you know about an important tax law change enacted by the Georgia Department of Revenue. This new law impacts all partnerships that have out-of-state, also known as non-resident partners. To understand the benefits that partnerships will experience with the new rule, I want to take just a minute to explain the old rule. The old rule was all about making sure that Georgia collected income tax from partners in Georgia partnerships that are not residents of the state of Georgia. At a high-level summary, the old rule said that partnerships must collect and remit to Georgia 4% of cash that was distributed to partners, even if the partnership had a taxable loss because of depreciation and other non-cash deductions. This new rule, which takes effect this year, impacts all partnerships with non-resident partners. We think this law change is fair and reasonable. The new rule states that Georgia partnerships are only going to collect the 4% tax on the actual taxable income that is passed through to the non-resident partner. Also, Georgia Department of Revenue has changed the administration of taxing non-resident partners. Let's take a look at this new law through the eyes of the real estate industry, where partnerships thrive. For real estate partnerships, trying to file and keep up with monthly and quarterly withholdings and distributions under the old rule was burdensome. With the new rule, administration is lightened. For example, real estate partnerships now only remit the withholding when the tax return is filed, or at the latest April 15th if the partnership return is being extended. It's just a one-time payment when the income can be reasonably estimated. This new rule is all about reducing the administrative burden of remitting and collecting the taxes from non-resident partners. Also, for the first time, non-resident partners can exempt themselves from withholding. They have to sign an affidavit acknowledging they will file Georgia returns and that they are still subject to Georgia income tax. So what's the big so what with this new rule? Partnerships with non-resident partners now have control over their money. Under the old rule, the money was being mandatorily withheld and remitted to the Georgia Department of Revenue, and then partners could get refunds upon the filing of tax returns. This new rule gives partnerships more control over working capital to use as they see fit for their businesses. Here's what you need to do now. Stop immediately further remittance of withholding payments. Start planning now with your accounting partner to comply with this new rule. And start planning with non-resident partners to determine whether they're subject to future withholdings or get them to sign the non-resident affidavit. If you have any questions, feel free to contact me, Dan Murphy, at dan.murphy@hawcpa.com. Thank you.